Welcome to the deep dive. We are jumping straight into the numbers today, looking at a company, well, whose financial story is really one of relentless expansion, but it's also meeting some serious cost pressures.
Exactly. And today we're doing a deep dive specifically into the financial and operational view that the CFO delivered in their Q3 2025 earnings call remarks.
Right, just the CFO's take for this one.
Yeah, and it's a great source because it really shows a company that isn't just, growing, but is genuinely differentiating itself in that quick service space.
Okay, so our mission here.
Well, I think our core mission is to unpack this specific quarter. We want to see how they kept that powerful growth going, how they're handling capital efficiency, and crucially, exactly where those margins are getting squeezed.
It really is a financial tightrope walk, isn't it? And the CFO's summary gives us a pretty crisp view. So let's kick off with the top line. That immediately shows that strong momentum you mentioned.
Yeah, the numbers are impressive right off the bat.
For Q3 2025, total revenue hit $424 million. I mean, that's a massive 25% growth year over year, $85 million more.
And, it isn't just a big number, it's a quality big number, right?
Right.
The same shop sales growth, the SSSG, came in at a very healthy 5.7%.
And just quickly for listeners, SSSG, that's the standard way to measure how existing stores are doing year over year.
Precisely. And here's the really interesting bit. Almost all of that growth, like 4.7% of it, came directly from transaction growth.
Transaction growth. So more people actually walking up, buying drinks, not just, price hikes on the same number of drinks.
Exactly right. And in this kind of economic climate, where you see consumers getting really sensitive to pricing, sustaining momentum through sheer customer volume, that makes them stand out.
Yeah, definitely an outlier there.
It shows they're successfully pulling in new business or getting repeat visits without just cranking up prices. That says a lot about their value, their customer experience, everything.
Okay, and if we drill down just into the core business, the shops, the company actually operates itself, that transaction strength looks even more stunning.
Absolutely. Company-operated revenue was $393 million. That's up 27% year over year. Huge jump.
And the SSSG for their shops.
Even better.
Yeah.
An outstanding 7.4%. And again, the driver was volume. Get this, 6.8% of that 7.4% increase came directly from more transactions.
Wow.
So these shops aren't just pushing sales, they're really maximizing their resources, their labor. That kind of volume-driven growth, it just builds confidence in their whole model, their site selection, everything.
Okay, so the revenue engine is clearly roaring. But growth isn't everything. Efficiency counts just as much. Let's look at profitability.
Yeah, the bottom line.
Adjusted EBITDA for the quarter landed at $78 million. That's a solid 22% increase over last year.
$14 million up.
And adjusted EPS, that came in at 19 cents, up 19% from 16 cents. Now, here's maybe the key metric for operational health. The company-operated shop contribution margin, it was 27.8%.
And that 27.8%, that's exactly where let's call it the financial battle is being fought. It's where you see that phenomenal sales execution meeting some pretty severe external pressures.
Right.
The CFO actually broke down the key items hitting this margin. They measure it as a percentage of company-operated shop revenue, or COSR. You can think of COSR as like the total revenue pot for their main business units before you factor in corporate overhead.
Okay, so strong revenue, we've established that, but we know costs are fighting back. Let's unpack the challenges. What were the main things dragging the margin down?
So there were three key areas, and each one drove about 60 basis points of unfavorable pressure compared to last year.
And just to clarify, a basis point is 1/100%. So 60 basis points is 0.6%. Doesn't sound like much, but it adds up fast.
It really does, across thousands and thousands of transactions. So the first and maybe the most critical headwind was in beverage, food, and packaging costs. That came in at 25.9% of COSR.
And that 60 basis point hit was mainly from coffee, right?
Yeah, primarily higher commodity costs, specifically coffee.
And coffee's their lifeblood. So any sustained spike there has got to be a major concern.
Absolutely. And the CFO was pretty clear. These high coffee costs, they're not going away. In fact, they expect them to accelerate into Q4.
Oof, accelerate.
Yeah, and potentially stay elevated well into 2026. So this isn't just some temporary blip. It's a structural pricing challenge they have to manage, and they seem determined to do it without hurting that customer value proposition.
Okay, so that's headwind number one, coffee costs. What was the second factor pulling down the margin?
That was occupancy and other costs. Came in at 17.0% of COSR. Also 60 basis points unfavorable year over year.
Okay.
Now, this was interesting because it actually comes from a strategic choice, a long-term decision they've made. The pressure here is driven by the occupancy rates from new shops, specifically because they've shifted toward these more capital-efficient build-to-suit lease arrangements.
Wait, hang on. If the new arrangements are more capital efficient, meaning less cash up front,
Okay.
why does that hurt the operating margin in the short term? That feels a bit backwards.
Yet it does seem counterintuitive, but it's a classic trade-off, you see. They're moving away from spending big chunks of capital up front on building stores.
Right.
Instead, they're using these build-to-suit leases where essentially the landlord finances the construction for them. Now, this massively lowers their average capex per shop.
Which makes their aggressive expansion cheaper and faster.
Exactly. But the flip side is the resulting lease payments are higher than if they own the building outright or used a more traditional model. So they win on capex, saving cash up front, but they pay for it with higher short-term occupancy costs as a percentage of revenue.
Got it. So it's a structural thing.
Yes, and it's expected to continue through Q4 and into 2026 as they keep building shops this way.
Okay, that makes sense. It reframes that cost pressure. It's not inefficiency, it's a planned shift to fuel faster growth. What about the third drag on margins?
That was pre-opening expenses, came in at 1.8% of COSR, again, 60 basis points unfavorable, and this ties directly into their strategy of expanding into newer markets where maybe they aren't as established yet.
So setting up in new territory costs more upfront.
Right. When they go into a new region, they have to send in specialized training teams, to make sure the culture, the operations, everything is consistent right from day one. That adds cost, definitely, but it's pretty essential for keeping the brand experience solid as they scale past, 1,000 shops now?
It really sounds like they're consciously choosing to invest heavily in the physical expansion efficiency with those leases and in the operational consistency with training, even knowing it dings the quarterly margin rate. But surely something was working in their favor. Some cost levers.
They did have one major positive, and that was sales leverage, especially on labor. Labor costs actually came in at 27.5% of COSR, which was 10 basis points favorable compared to last year.
Favorable how? With wage pressures and everything?
Well, despite those earlier investments they made in labor and minimum wage hikes in places, that incredible volume growth, remember that 7.4% SSSG in company shops,
Yeah.
it allowed them to use their existing staff much more efficiently. More sales per labor hour, essentially.
Okay, so the sheer speed and volume of the business helps offset other rising costs. That makes sense.
That's a big part of the story. However, the CFO also flagged a specific sharp pressure point coming in Q4, specifically hitting that labor line.
Oh, what's that?
They're bracing for about a 50 basis point negative impact just from regulatory changes in California. Apparently, it's leading to higher employer payroll taxes there.
California. That's a specific geographic risk hitting them in an already high-cost state. Definitely something the market will watch closely, especially as they keep expanding there.
For sure. Now, moving up from the shop level, looking at corporate costs, things look pretty well managed. Adjusted SG&A selling, general, and administrative expenses was $58 million, or 13.6% of total revenue.
And are they getting leverage there?
Yeah, the CFO said they expect to get about 110 basis points of leverage on adjusted SG&A for the full year 2025. That basically means their corporate overhead is growing slower than their overall revenue. Shows good discipline as they scale up.
Okay, let's pivot back to growth then. The expansion pace seems relentless. How many shops did they open in Q3?
They opened 38 new ones in the quarter, bringing the total system count up to 1,081 shops.
Over 1,000 now, wow.
And the outlook for development is still very firm. They confirmed they're sticking to their full-year target, 160 new system shops for 2025.
All right.
And they added some important context for next year, for 2026. They basically said if they open slightly fewer than 160 this year, those openings will just get added on top as an accelerated target for 2026, which is around 175 system shops.
175, that's stepping it up even more.
It signals huge confidence, doesn't it? Both in their real estate pipeline and their ability to execute that capital-efficient build-to-suit model we talked about.
And we saw that efficiency in the numbers too. Average capex per shop was $1.4 million, right? Confirming that strategic shift is happening.
Exactly.
Now let's talk about maybe the next big growth catalyst, food. We actually got some solid data points on the hot food program rollout.
Yeah, this is strategically really interesting because it potentially opens up totally new times for people to visit. The CFO confirmed that the early results from shops with the hot food program are showing roughly a 4% comp lift.
A 4% comp lift is significant. That's a real revenue boost on its own.
Absolutely.
But the key question is Is that just existing customers adding, I don't know, a muffin to their usual coffee order? Or is it actually bringing in new business, new visits?
That is the critical question. And the answer, well, it sounds quite promising. The CFO specifically said that about a quarter of that 4% list, so doing the math, about 1% of the total SSSG is coming purely from transaction growth.
Okay, transaction growth again.
Yeah, which strongly suggests it's either new customers or maybe more likely existing customers coming in at a totally new time, perhaps for breakfast, or, an occasion they previously skipped. It seems to prove the food program really is expanding their reach across the day.
But didn't we hear earlier that the costs associated with rolling out this food program more widely are expected to start hitting margins in Q4?
We did. That's the other side of the coin.
So how nervous should people be that this nice 4% lift might just get eaten up, pardon the pun, by the costs of actually doing it, at least in the short term? It's that margin versus growth tension again.
That is absolutely the core tension for Q4 and probably into next year. You've got those headwinds we discussed, the accelerating coffee costs, the new California tax pressure, plus the added complexity and cost of rolling out a major food program nationwide.
Right.
Now, that 4% comp lift, that provides really excellent revenue cover for those new costs. But the market is going to be watching that Q4 contribution margin number like a hawk. Management is essentially choosing to trade some immediate margin defense for hopefully future market share and getting customers to visit more often.
Makes sense. So given all this strength, particularly the momentum carrying into October, it wasn't a huge surprise they raised the full year guidance, right?
No, it followed logically. They bumped up the total revenue projection.
Yeah.
The new range is $1.61 billion to $1.615 billion for the full year. And they also nudged up the system SSSG forecast for the full year to approximately 5%. Now, if you work backwards, that implies they expect Q4 SSSG to land somewhere in the 3% to 4% range.
Which is still pretty solid considering they're up against a strong Q4 from last year.
Very solid.
Yeah.
But here's the telling silence, perhaps. They kept the guidance for adjusted EBITDA, the main profitability metric, completely unchanged. Still in that previous range of $285 million to $290 million.
Oh, so higher revenue forecast, but flat profitability guidance. That pretty much confirms that they expect the extra revenue to be basically canceled out by those mounting cost headwinds we've been talking about.
Exactly. The coffee, the new taxes, the initial food rollout costs, it all adds up.
So they're running faster on the top line just to stand still on the bottom line, at least for now.
That's a fair way to put it for this period.
Uh-huh.
They're executing incredibly well on volume and growth, which is allowing them to absorb these external costs. But the challenge, the next step, is turning that growth from just covering costs into actual meaningful margin expansion.
Okay, let's try and wrap this up. Bringing it all together, what's the main takeaway our listeners should get from this deep dive into the CFO's report?
I think the core message is that their differentiated model, focused on that beverage-first experience, high-speed service, it's clearly resonating. It's driving exceptional customer demand, really high transaction growth.
Yeah, the volume is key.
And that volume is delivering financial scale. It's reinforcing confidence in their very aggressive long-term growth plans. They seem to be successfully pulling the levers needed to capture market share right now.
The numbers definitely back up their talk about delivering, what was the phrase? Consistent, dependable results? But it's definitely a complex picture.
It is. And maybe if we connect this back to the future, the central tension, the thing for you to really think about is this. We've seen they have this strong customer demand, strong enough to raise revenue guidance. So the question becomes, how effectively can they manage those persistent structural cost headwinds?
Specifically the coffee and those regulatory taxes.
Right. Can they manage those well enough to actually achieve meaningful margin expansion in 2026, all while continuing to rapidly scale the number of shops and roll out this big hot food program? That balancing act, managing costs versus driving growth on multiple fronts, that's the real story to watch over the next, say, 18 months.